In this class we're going to look at the profit and loss account. The profit and loss account is a summary of revenues and expenses for a certain period of time. It's the balance that's between revenue and expenses. So it's the difference between revenue and expenses, and that's equal to net income or net loss. And net income is just another way of saying profit. Very simple profit and loss account. We have revenue of 10,793 and costs of 5,318, and subtract one from the other and you get the net profit, 5,475. So very straightforward exercise. Take away cost from revenue. It is a profit and loss account after all, so that's what it would suggest. Revenues are gross sales, that is money received for goods and services sold. Goods returned and discounts are deducted from gross sales to yield net sales. And companies may record their revenues and costs on either an accrual or cash basis. Now this term accrual, well, an accrual basis records revenues and costs in the year in which the sales take place. The revenue from the sales may not be received until a future time period. So if a sale is recorded this year but the actual payment is received next year, that's called an accrual. It's a payment in the next accounting period, but the actual transaction took place in this accounting period. The sum was paid in the future. A cash basis records revenues and costs in the year in which the payment is received. So an accrual involves two time periods. Perhaps the sale takes place now, but the revenue is received in the next time period. That's an accrual. A cash one is the sale takes place now and the cash is received now or in the same time period. Expenses. Expenses may be classified into two parts. The cost of goods sold. This is calculated as follows. The opening inventory plus purchases, which gives us 4,724, less closing inventory, less what is in stock at the end, which in this case is 612. So the cost of goods sold is 4,112. Now, as for inventories, well, there are different ways of valuing inventories, and this will be dealt with in a class on stock control. So, a larger topic. Just to mention briefly what's going to come up, stocks may be valued on the basis of the last in, first out. In other words, taking the current prices. Or it could be first in, first out. Or it could be some average. So trying to price up the stocks is not a straightforward exercise. But as I said, that's dealt with in a separate class. So let's look at ABC Limited. Trading and profit and loss account for the year ended 31st of December 2000 and something. So ABC Limited, a very original name. Well, we've got sales. You may wish to expand the video somewhat to get a full view of these. We have sales, opening stock, and we also have purchases. So the sales are 10,294, and then we have the opening stock and the purchases, which gives us the total in stock, less the closing stock, which is 612. So the cost of sales is 4,112. In other words, if we subtract that from the sales figure, we have a gross profit of 6,182. So that's our gross profit. We have to take away from the gross profit all of the expenses of running the business, and that will reduce it. So we have, for example, wages and salaries, rent, power, distribution, maintenance and repairs, marketing, depreciation, and others, which could be just general office expenses or some other form of costs. So when you tot up all of those, it comes to 5,307. Now, if we subtract the 5,307 from the gross profit, 6,182, we get an operating profit of 875. Now we have to pay interest to the bank of, let's say, 180, so the net profit after interest is actually 695. Then we must pay taxes. We must always pay taxes, so it's 170. So the net profit after tax is 525. Then we must pay the dividends. That's a return to the owners. The owners put money in to the business. They invested in the business to start it up and invested in the business throughout the life of the business perhaps. So they get a return called a dividend, and in this case it's 200. So now the retained profit is 325. The retained profit brought forward, BF, brought forward, is 719. That's brought forward from a previous time period. So the retained profit carried forward, the retained profit CF carried forward, in other words, the retained profit from now on until the next set of accounts is 1,044. BF means brought forward. This means that we take the total of a page or column to the head of the next page or column where it is said to have been carried forward. We could do all of that again. We could say, look at the previous year's accounts, and they're drawn up in exactly the same way. The bit I want to talk about here is the retained profit. So the retained profit is 390 from 2010, and the profit brought forward from the previous year, perhaps 2009, is 329. So the actual retained profit is 719. And that's how we get that figure. So it's just carried forward from the previous time periods. So that concludes our talk on profit and loss. It's a straightforward account. We just need to know what goes into the account and how it's drawn up. And of course this figure is very important because it shows how successful or not the business is. It's also used in the balance sheet, and it's used in many documents, important documents for the business. Certainly if the business wished to borrow money from a bank or from some institution, they would want to see the profit and loss account. And of course the profit and loss account is a part of financial accountancy, and this would be signed off by professional accountants, so that it is a well accepted figure. It's a well accepted figure at the end, the profit or the loss. It's signed off by accountants, it has been checked, and it is an important figure. That's all I want to say about this, so thank you for watching.